A significant shift is underway in global finance, a movement that is quietly but powerfully reshaping the world's investment landscape. For decades, the United States stood as the unrivaled destination for investors, celebrated for its dynamic markets, innovative spirit, and the dominance of its tech giants. But today, on July 1st, 2025, we are witnessing a remarkable pivot. The flow of global capital is turning toward Europe, signaling a new era for the continent. Money is no longer just pouring into Wall Street. Instead, it's crossing the Atlantic, seeking out fresh opportunities and safer harbors in European markets. Investors are now viewing Europe as a continent reborn, one that is brimming with renewed purpose, untapped potential, and a sense of stability that's hard to find elsewhere. This isn't just a fleeting headline or a passing trend, it's a deep transformation, visible in the decisions of pension funds, the strategies of major corporations, and the shifting allocations in personal investment portfolios. The old belief that America is the only game in town is being seriously challenged for the first time in a generation. European markets, once dismissed as sluggish or outdated, are now being recognized as stable havens, places of calm and reliability in a world that feels increasingly unpredictable. The reasons for this shift are many. Europe's political predictability, its forward-thinking industrial policies, and a growing demand for reliable, long-term returns. This transformation hasn't happened overnight. It's been building slowly, like pressure before a storm, as investors quietly reassessed their options. What began as small trickles of capital have grown into steady streams, and now, a powerful current is flowing into Europe's financial system. Europe is getting its house in order, investing in sustainable growth, green infrastructure, and the industries of the future, like clean energy, advanced manufacturing, and digital innovation. Investors who are weary of volatility, political drama, and economic uncertainty are increasingly drawn to Europe's steady hand and measured approach. The continent is no longer just a destination for tourists or history buffs. It's rapidly becoming a top spot for serious global capital and forward-thinking investors. This isn't about abandoning America altogether. It's about diversification, prudence, and the search for balance in a world where risks are rising. Global investors are spreading their bets more widely than ever before, and Europe is emerging as a prime beneficiary of this new, more cautious approach. In these uncertain times, the continent's stability, resilience, and commitment to progress are exactly what many investors are seeking, and Europe is ready to deliver. What's Europe doing right? Why does it continue to attract investors and businesses from around the world, even in uncertain times? The answer lies in stability, strategic investment, and regulatory clarity, three pillars that set Europe apart on the global stage. In a world rocked by surprises and volatility, Europe offers a rare sense of calm and predictability. For long-term investors, this is like gold, an environment where careful planning and steady growth are possible. The EU's robust regulatory framework gives companies the confidence to plan for the future, free from the fear of sudden, unpredictable changes in policy or law. Europe is not standing still. It's actively building its future, launching ambitious infrastructure projects and fostering public-private partnerships that drive innovation and connectivity across the continent. These projects don't just create impressive structures, they generate thousands of jobs, stimulate demand in local economies, and lay the groundwork for decades of sustainable growth and prosperity. Europe's industrial powerhouses are thriving, especially in sectors like green energy, advanced manufacturing, and high-tech innovation. The continent is leading the global energy transition, developing cutting-edge technologies in renewables, electric vehicles, and hydrogen power, setting new standards for the world. Europe's unique social model with strong safety nets and a focus on worker training ensures a stable, skilled workforce ready to meet tomorrow's challenges. This balanced approach, valuing both economic dynamism and social cohesion, makes Europe remarkably resilient even in turbulent times. It's a winning formula, providing a secure foundation for investors and a blueprint for sustainable, long-term success. The numbers confirm this shift. Over the past 18 months, more than $100 billion has flowed into European equity funds. This dramatic reversal signals global confidence in Europe's prospects. Big players, sovereign wealth funds, asset managers, are increasing exposure to Europe. Germany, for example, attracted over 46 billion euros in new FDI last year. This money is building factories, research centers, and logistics hubs, creating long-term value. Companies like Siemens Energy and Holcim are thriving, reflecting the trend toward tangible, value-oriented investments. Meanwhile, U.S. equity funds have seen net outflows of $87 billion. The contrast is clear. Europe is now the more attractive proposition for many. The flow of money is the ultimate market signal. Right now, it's pointing eastward across the Atlantic. As Europe's appeal grows stronger, a thick cloud of uncertainty now hangs over the U.S. investment landscape, making investors increasingly cautious about where to put their money. Policy unpredictability and ongoing political gridlock in Washington have made long-term planning a real challenge for businesses of all sizes, from startups to multinational corporations. Key issues like taxes, regulations, and infrastructure spending seem to swing dramatically with each election cycle, leaving companies unsure about what rules they'll be operating under just a few years down the line. Investors by nature dislike uncertainty. Right now, the U.S. is serving up plenty, making it harder for them to commit capital with confidence. Trade wars and unpredictable tariffs have disrupted global supply chains, raised costs for manufacturers, and forced companies to rethink their sourcing strategies. This wave of protectionism has made international companies increasingly hesitant to invest in the U.S., fearing sudden policy shifts that could impact their bottom line. This isn't just a theoretical risk. Major projects have already been delayed or outright canceled due to the unpredictable policy environment, costing jobs and slowing growth. The numbers tell the story. International firms are now looking elsewhere, as reflected in the $87 billion that have flowed out of U.S. equity funds in recent months seeking safer havens. The U.S. still boasts incredible dynamism, world-class talent, and a culture of innovation, but deepening political division is acting as a major headwind, slowing progress and eroding confidence. Until a sense of stability and predictability returns, investors will continue to prefer Europe's clarity, lower risk, and more consistent policy environment. The U.S. edge in global markets is being eroded not by foreign competitors, but by internal division and a lack of clear direction. The lesson is clear. Capital always seeks stability, and right now, Europe is offering more of it, attracting investors who crave certainty. Investors are voting with their feet, moving their money and operations to places where the future looks more predictable. If the U.S. wants to regain its former appeal and leadership, it must address its policy environment, restore predictability, and rebuild trust with the global business community. For now, Europe stands out as the safer bet, offering the stability and growth potential that today's investors are seeking. This shift isn't just numbers, it's happening in boardrooms worldwide. CEOs are redirecting major investments to Europe, citing stable energy costs, skilled labor, and government incentives. A major Asian electronics firm chose France over US states for a new semiconductor plant, thanks to Europe's clear industrial strategy. International fund managers are increasing allocations to European infrastructure and private equity. They value Europe's predictable regulatory environment and political will behind the green transition. These decisions are pragmatic, based on risk, reward, and partnership. European leaders are actively courting investment, offering concrete incentives. The pivot is being executed by those who decide where to build the factories and create jobs. The message is clear. Europe's stability and vision are winning over global business leaders. Europe's momentum is strong, but complacency is a risk. The continent must streamline bureaucracy and speed up project approvals to stay competitive. Sustained growth requires fostering innovation, supporting startups, and reducing red tape. Europe can't compete on cost alone. It must focus on high-value manufacturing, R&D, and leadership in green and digital transitions. Unity is key. Internal divisions can undermine progress. Political cohesion on energy, digital, and trade policy is essential for investor confidence. If Europe stays agile and united, it can solidify its position as a global investment hub. The opportunity is there. Europe must seize it. Don't write off the United States. The American economy is resilient with unmatched tech leadership and deep capital markets. Current outflows reflect policy uncertainty, not a lack of potential. A stable political climate could quickly reverse the trend. Renewed focus on infrastructure, energy, and trade could restore investor confidence. The U.S. still leads in innovation, AI, biotech, space exploration. Europe is rising but hasn't matched the U.S. ecosystem of venture capital and risk-taking. The shift to Europe is a wake-up call. not a permanent decline for America. The US can reclaim its leadership with political will and stable policies. The game isn't over. A US comeback is very possible. This global shift affects everyone, not just Wall Street. For Europeans, more investment means jobs, better infrastructure, and higher living standards. For Americans, outflows could mean slower job growth and delayed upgrades. If your savings are US-focused, you may see underperformance. The lesson: diversify. Don't put all your eggs in one basket. A balanced portfolio should include international, especially European, exposure. This isn't about abandoning the US but building resilience. Global capital flows affect everything from mortgage rates to consumer prices. Understanding these trends helps you make smarter financial decisions. Your financial future is tied to the global economy. Think globally. 2025 is a year of global rebalancing. Europe's stability and vision have made it a land of opportunity. The numbers and corporate decisions all point to Europe's rise. This isn't American decline, but renewed competition. The US can recover with stability and collaboration. For investors, vigilance and global diversification are essential. Europe's rise and America's potential recovery both offer opportunities. The great rotation of capital is healthy, driving smarter policies worldwide. No country's dominance is guaranteed. Adaptation is key. The world is full of shifting opportunities for those who pay attention.